Hey everybody, and welcome to another live here on the mortgage scene. Today we are talking about down payment assistance programs and grants, and I'm really excited to be here this morning. We got a full house here, so I'm not going to waste any time. What we're going to do today is we're going to talk about down payment assistance programs and grants, but we're going to do it specifically for the Northern Virginia market. The reason why is because as I was preparing for this, there's a lot of information and I don't want to go too much into the weeds. So we're going to talk about Northern Virginia specifically. If you want me to do a future video on Maryland programs and DC programs, go ahead and give this video a like. And if you don't know, my name is Tim Kelly. I am a loan officer right outside of Washington, DC in Reston, Virginia. I am with Atlantic Coast Mortgage, and we are located here in Fairfax, Virginia. So before we kind of jump into this and the down payment assistance grants, just kind of wanted to revisit a few things. And if you were with me 2 weeks ago when I did my Homebuyer Finance 101 class, or you saw the recording, and now you're watching this, we're going to run through the next couple of things really quickly, but it's kind of just recaps because it's kind of important, before we go any further talking about down payment assistance and grants, because you kind of have to understand how things work. So there's the secondary market and the primary mortgage market. If you watch that video, I talked about comparing that to the auto industry. You have auto manufacturers and auto dealerships. Mortgages are very similar. You got mortgage manufacturers. That's going to be the secondary market where you have Fannie, Freddie, Ginnie Mae, and then you have state and local housing agencies. And the primary mortgage market, that's essentially the mortgage dealership. That's where you find me, loan officers like me, companies like Atlantic Coast Mortgage. And what we do is we sell their products, okay? So when we go through these, just understand that how that kind of works. And you need to make sure before you talk to any lender or any real estate professional that you are establishing your household budget and going through the rest of these things that we covered in Homebuyer Finance 101. But it's really important. Number one, we're not going to be making the mortgage payment. You are. We're not going to be living in the home and dealing with the maintenance, mowing the lawn, and all the other upkeep that is required. You're going to be doing that. So make sure you do your due diligence before you move forward with any mortgage professional or real estate professional. Okay. Credit is ultimately going to be one of the biggest drivers. I talked about this previously. I've done a whole video. I'll link it. I'll kind of pin the comment to this video if you're watching the recording. But we talk about how to get a free copy of your credit report. You can check that out and learn more. But ultimately, your credit score is really going to drive which product, which program really works for you. And then when we dive into this, we're going to be looking at all these different products. You can use down payment assistance grants and programs with pretty much any of these products. So we'll kind of run through a little bit of these quickly. Conventional, that's Fannie Mae, Freddie Mac, basically your bread and butter mortgage. Majority of loans in the country are going to be falling under conventional loans. You're able to use a conventional loan and put down as little as 3% if you're a first-time home buyer. And if you have credit issues or concerns, a lot of people use FHA financing. There's nothing wrong with FHA financing. I used it to purchase my first home, which we'll talk about here in a moment. But that allows for 3.5% down payment. It allows for lower credit scores without having a major impact on the interest rate and affordability like it would have on a conventional loan. And it's a great product. And if you are active duty or a veteran or you have entitlement that's been passed down to you, it is a VA financing is a great option. And we'll talk about a grant program specifically that you can use with a VA loan here in this presentation. USDA is a rural housing program. It's very similar to FHA, but it's for certain geographical areas, what they consider to be rural. But another great product that offers 100% financing. And then we have non-conforming. These are loans that don't fit those guidelines. They might be because of the loan size or a particular niche program because of your employment that you would need to use. We're not really going to talk about any of that stuff in this. What we're really going to be talking about is just your conventional FHA and VA loans. And by the way, if you do go to hud.gov/states, you can get a lot more information about things we're going to be talking about here today. So with that being said, what is a down payment program? Well, there's a couple different types. So let's just discuss that real quick. And if you do have any questions, go ahead and put them in the comments. I will be monitoring the chat during this live. Also, if you're watching this in recording, you can always type your comment and I'll be sure to monitor that and get back to you as quickly as we can. So a grant program, there's true grants. These are loans that usually never need to be repaid. They're not recorded on the home, and they might require some sort of specific disclosures or specific reason why you are able to qualify or use that grant. Secondary mortgages, these are down payment assistance programs. These usually come behind your first trust mortgage and offer a second trust to help cover the down payment plus maybe some of the closing costs. And then you might find some assistance programs through your employer, through the state, or your local housing agency. Like here in Northern Virginia, we have Virginia Housing, which you can use. And then there could be nonprofits that also offer some assistance, whether it's grants or down payment assistance programs. So how this is going to work for this live is we're going to talk about the multi-state programs, things that you can use, whether you are in Maryland, DC, Virginia, or any state that you have a licensed Atlantic Coast Mortgage loan officer. You can take advantage of some of these programs. So we'll talk multi-state and then we'll dive into Virginia. And again, if this video gets, we'll say 25 likes, I'll do a version for Maryland. Okay. So what we're going to do is we're going to talk about the program specifically, and most importantly, the amount that it gets you, whether the funds are available or not. More about that in a moment. And then if there's income limits and geographic limits as well. So we have the AMC HomeStart Grant. This is a grant that we offer. It's up to a $4,000 grant or 1% of the purchase price or loan amount. The max loan amount for this product is $400,000. So just keep that in mind. There's no depletion of these funds. You can use it anytime. You do have to be a first-time home buyer. One of the borrowers has to be a first-time home buyer, and there is an income limit of 80% of the adjusted median income. And you can use, again, this product anywhere that AMC, Atlantic Coast Mortgage, is licensed. So what we're going to do is we're going to talk about a borrower, give an example, and my title here got cut off. But basically, each time we go through one of these grants, we're going to go through an example. And so we're going to start off with the HomeStart Grant, assuming this person is a single individual making $95,000 a year. And they're just purchasing here in Northern Virginia. In this case, because we have a limit of $400,000, they are purchasing a townhome for $400,000, okay? Because anytime you use any of these assistance programs or grants, you want to make sure you compare it to what it would look like if you did not use them, okay? So it's how you know what the true benefit is if you don't compare what it would look like to move forward with this purchase without this down payment assistance or this grant. So we have a software that allows us to compare 4 different financing strategies side by side. Right now, what we're doing is we're comparing this person who is paying $3,000 a month in rent to purchasing this $400,000 townhome. Using the second column here is a standard conventional Home Ready loan. Home Ready is a loan product that you can use just if you are within a certain percentage of the area median income you're purchasing, and it offers some discounts on interest rates and mortgage insurance. So in this case, we're comparing that standard Home Ready product to using the grant. Okay, so $400,000 purchase price. You can see that there's really no catch to this. The payment, the rate does not change. All that's changing is that you're getting a $3,880 grant, 1% of the loan amount that's being applied towards the closing. So with the standard conventional Home Ready product, your cash to close is just over $25,000. If you are eligible for this grant product, you can use it, and it would just drop your cash to close to just over $21,600. Okay, and if you're wondering, the difference between renting versus buying, one of the great benefits of owning a home is the tax benefits. So after the tax benefits, after the amount you're putting towards your principal, the net payment comes out to be a little bit lower than you would be paying with renting a home for $3,000 a month. Over a 3-year period of time, that $3,000 a month ends up coming to be just under $114,000 out of your pocket. Whereas if you use one of these products, you'd be putting around $13,500 towards your equity, building your net worth, which in this illustration here at the bottom, You can see your estimated net worth, assuming your home appreciates 4% every year over the next 7 years, which is kind of what's being forecasted here in Northern Virginia based on some recent studies that we've seen. If you were to earn 4%, that example borrower that we were looking at had $30,000 in the bank earning 4% return. After 7 years, it's almost $40,000. Whereas if that home that you're purchasing for $400,000 was appreciating 4% every year, you're paying down your principal a little bit every month, your estimated net worth is substantially higher. And again, I've said this multiple times in many videos here on YouTube and all throughout social media and for years. In my opinion, there's no quicker way to build your net worth than through real estate. The catch is you just need to make sure you do it right. And there's so many options that you have when purchasing your first home. For example, in addition to this HomeStart Grant, this 1% grant, we also have a VILP, which is a $2,500 grant that you get. The catch and the difference between this product and the previous one that we talked about is that you have to be within 50% of the AMI. Again, that's based on Fannie and Freddie's calculation. You can look that up. It's definitely a great option. Like here in Northern Virginia, I looked it up earlier in Reston using a 20191 zip code. 50% is about $82,000 a year. So you are eligible to take advantage of this $2,500 grant if you would qualify for it. And again, this is just adding on top of your product that you're using. So if we're looking at the same borrower, again, the biggest difference here is that his income or her income went from $95,000 down to $80,000. Okay. Other than that, it's very similar. Your interest rate's not changing. Using this grant product, you're just dropping your cash to close $2,500. Okay. The big difference between these two is the max loan down payment for the HomeStart Grant is 5%. If you put down more than 5%, you're no longer eligible for the HomeStart Grant, that 1% grant. Whereas with the VILP grant, you can put down more than 5% and get that $2,500 as long as your income is below 50% of the adjusted median income. So those are two grants that never run out of funds, okay, that are always available, that we're always looking into if our clients qualify for that. Another grant product is FHLB Set Aside Grant, and this is a grant that funds are not always available. It does run out of funds. These are an annual pot that is divvied up across the country to different banks and lenders from the Federal Home Loan Banks. This is an organization that partners with lenders and community banks to provide products like this, grants like this, assistance to help people. So you can take advantage of this product. We had someone earlier this year, but these funds go very, very quickly. If you're a first-time home buyer, you can get up to $17,500. If you're a community partner, that's someone like a nurse, a first responder, you can get up to $20,000. Okay. We did one earlier this year for a nurse, and she got $20,000. And this can be on top of any other grant or product that they're using. Their income needs to be within 80% of the AMI, and that is based off of HUD. So, for example, in Reston, Virginia, Fannie and Freddie's 80% is based on their calculation is just over $131,000. Compare that to HUD's. It is $106,000. So there's a major difference there between HUD and Fannie and Freddie. And this one is using HUD. So what's nice about it is you can use any product. So again, we're comparing the same borrower. In this particular case, they've got a higher income, but staying below that 80%, that $106,000 here in Northern Virginia when we looked it up. And they're still buying that same property, the $400,000 townhome. And you can see here, there's no change to the interest rate. There's no change to the terms of the loan. All they're doing is they're getting a $17,500 grant. So the cash to close drops from just over $25,000 to just over $8,000, a substantial savings, which you can see here. If we look at the net worth, there's a big difference between the net worth with using this grant product. And that's one of the biggest benefits when it comes to utilizing these is you are keeping that money in your pocket that you can use to pay off other debt, to fix up the home, furnish the home, save for maintenance costs that can come up down the road. But again, it is a great product. It's just very limited. So you need to make sure that you are fast when those funds become available. And the other FHLB product that they have is called the Workforce Grant. And this is a $15,000 grant that is not just for first-time home buyers. You can be any buyer. It's just that you have to be within 80 to 120% of the area's median income. Again, looking at Reston, Virginia, that I looked up, that would be between 106,000 to 137,000. 106,000 to 159,000, and that's for a household size of 2. Okay, so it's all based on your household size, and that's a pretty wide range there, but a great product. And again, it is limited, so you got to act fast on that, and you've got to plan appropriately. We'll talk more about that here in a moment. So looking at that borrower as an example, we can compare the same scenario, the Home Ready product to the Workforce Grant. Not changing your interest rate, not changing your financing terms. You're just bringing $15,000 less. And again, this is not just for first-time home buyers. So our cash to close goes from $25,000 to just over $10,000. Again, not changing your monthly payments. Your net payment after the tax savings, after you're putting some money towards the principal, is the same, but your estimating net worth 7 years down the road is much higher because you've kept that extra $15,000 in your pocket. So another product that we have is 100% financing FHA loans. So this is now going from the grants to the down payment assistance. So the way that this works is that it is a second lien that's recorded, and you can get up to 3.5% to 5%. And the 3.5 version can be forgiven after a certain period of time. There is no income cap. You can use this anywhere that we're licensed. And if you take a look at the comparison here, this is where things can start to change. There's no free lunch usually with these products, right? So if we look at that borrower, comparing this to a standard FHA loan where you can get around a low 6% range today, if you were to take advantage of this FHA 100% financing product using the 3.5% loan that has to be repaid, the interest rate would be in the low 7% range. So that's causing your monthly payment to go up because now you're increasing your interest rate compared to a standard FHA loan. You're also paying back that 3.5%, but your cash to close goes from just over $27,000 to just over $14,000. Now, with these 100% financing products, you do have to kind of be careful because you're essentially starting upside down on the home. So you really need to make sure that you're going to be purchasing a home and that you're going to be in there for the long run. This is the first time we've seen the net payment, after the tax savings and the amount you're putting towards your principal be higher than what you're currently paying in rent using your standard deduction. But again, fast forward 7 years from now, if you use this product, you potentially can have a much higher net worth than you would have if you continued to rent and that home was earning 4% appreciation. But again, be careful here when you're doing these 100% financing products. Not every home, is going to appreciate the same. We're just using 4% as kind of an average here. But this is the first time where there's going to be a change to the interest rate when you're using these assistant programs. And we'll see more of that here as we go into Virginia housing. So these are products that are available in Northern Virginia, or really anywhere in Virginia, rather. There's differences between the income limits and the max sales prices where you are purchasing in Virginia. But here in Northern Virginia, you can use a Virginia housing product, purchase a home up to $800,000. The income cap here, as of this recording, for a household of 2, you can take advantage of a product like this, which is a DPA grant, a 2% grant with a conventional bond product, or 2.5% with FHA. If your household income is $148,000 or less, if you're a household over 3, it goes up to $174,000. The big difference here between the other grants that we talked about is there's no depletion of funds. You can get this 2% grant or 2.5% grant at any time during the year when you look to purchase a home. Again, watch out for the income limits, and those can change as where you are purchasing in Virginia. But if we want to compare this product to the standard products, we can take a look at the difference here. It's starts to see again the change in interest rate. We go from the mid sixes to the upper 6% range, about 1/4% difference between your standard home ready product using this Virginia Housing conventional bond product. But the difference is the cash to close goes from just over 25,000, which we've seen repeatedly here, to just over 17,000. So again, keeping that money in your pocket, and it's costing you a little bit each month, but we're not talking a major difference here. And if you look at the difference over time, your estimated net worth is higher if you go with this grant product, because you're getting that 2% and keeping that cash in your pocket, which is continuing to earn that interest, but you're paying down your principal a little bit less because of that higher interest rate. So it's a product I would highly recommend to use if you can. You just have to make sure that you're monitoring the interest rate, keeping an eye on it, and looking for an opportunity to refinance should you be able to. So the down payment assistance grant is great. We have helped several people use that, and what's nice about it, it's always available. Now, this is the CCA grant. This is a question I get asked all the time. Are there grants for veterans or active duty? And yes, there is. This is it. Again, really great product. There is income caps you have to watch out for. There's no depletion of funds, and this is only available in Virginia. Once again, if you want to see more on Maryland and DC, give this video a like, and I will do a future one for Maryland and DC. So let's compare a standard VA loan to using this grant. The biggest difference here is this person is a veteran compared to the other scenarios that we were running through. So if you look at this particular scenario, there's another change to your interest rate just because you're using this product through Virginia Housing, but you're getting a 2% grant. So they're still purchasing that $400,000 home. In this particular case, their monthly payment comes out to be just over $3,200 a month with a standard VA loan, but you got about 1/4% bump to your interest rate. These are all priced of this morning, could be slightly different in the future, but there's going to be a slight bump to your interest rate, which causes your monthly payment to go up. But look at the cash to close. A lot of times veterans are struggling to get their offers accepted because they're really looking for 100% financing and asking the seller for assistance. This is a great way that you can get 2%, $8,000 in this particular scenario that can be applied towards the cash to close, taking this client's cash to close from $13,000 down to just over $5,000. So if you do need to ask the seller for help, you don't need to ask, for the full closing costs. You can just ask for some of it, which makes your offer a little bit more competitive, a little bit more appealing for the seller. So we've helped veterans use this in the past, just in the last 60 days, and they were able to take advantage of this, and they ended up not having to bring any money to closing. In fact, getting the earnest money deposit back, almost a full deposit back, taking advantage of this grant and a little bit of a seller concession. So your monthly payment's a little bit higher, but in this particular case, the scenario that we ran for this example, this net payment after the tax savings and the amount put towards your principal is still better than renting. The estimated net worth is, again, higher. Biggest difference here is that cash that you kept in your pocket, that $8,000, is continuing to earn interest. So it is a great way for veterans to take advantage of the fact that they are first-time buyers, and they can use this product to reduce their cash to close without asking for the seller. And then we have the Plus Second. This is what I used to purchase my first home back in 2010. These other grants were not available. So this is really the only product at the time that was available if you were looking for 100% financing. And I used this product, I brought a townhome, I brought less than $80 to closing. I used the second trust mortgage that was allowing me to not just roll in just the closing costs, but also roll in a portion of, not just roll in the down payment, but also roll in a portion of the closing costs. So In addition to that, I only need to ask the seller for a little bit of extra money. Now, it's a great product. There's no worry about depletion of funds. You can use it any time. In this particular case, your income can be a little bit higher. In our example, we've gone from $90,000 up to $150,000. So in our example here, and why I wanted to point that out, if you are a household of two, you no longer qualify for the DPA grant, okay, if your income exceeds $148,000. So in this particular case, their income would be too high to take advantage of the 2% grant. Because if you can get the 2% grant, obviously that would be the route to go. But in this particular case, with their income being over $148,000, and if they needed help still with the down payment, this is a great way that they could do it, and they could take advantage and use this product, the same product that I used. So we want to compare, again, the standard conventional loan with 3% down to using this. You'll notice there is a difference in the interest rate. As of this morning, when I was pricing this out, it's about a 3/8% change to the interest rate. But again, what I find in our market here in Northern Virginia, the Washington, D.C. metro area, we have a lot of what I call Henrys, high earners, not rich yet. People might be able to afford the slightly higher payment. They just don't have enough funds to cover the down payment or all of the closing costs. And so they need to use advantage of their ability of taking these products, the down payment assistance, the grants, to get into home, to start that property ladder. But there's a big difference between the right way and the wrong way. So this is another product that you would want to use and really monitor interest rates. Again, the catch here is that you're starting with 100% financing. If you look at that loan size here, the purchase price, the top row, $400,000, and you look at the loan amount, in this case, you're fully leveraged. You owe more than you purchased the home for. So you really need to make sure that you're going to be in this home for the long term if you're going to be using a product like this. When we purchased our home, we bought in 2010. Homes were relatively low at the time, and so we just had the expectation that our home was going to appreciate. And after 5 years, it appreciated enough to the point we were able to refinance the home. But it's a great product. You just, again, have to make sure that you're comfortable with the payment, because if you look at the net monthly payment, again, that's after the tax savings and amount towards your principal. You're basically coming out to be dead even in this renter's scenario. So it is, in this particular case, would be more affordable to rent each month. But if you look over the long term, their estimated net worth is substantially higher after they owned this home for 7 years, which appreciated 4% every year. And again, it's higher with this product because they kept some additional funds in the bank that was earning appreciation. But over time, because of that higher payment, it's going to even out, and that standard conventional loan would be the better option. You just really have to be making sure that you're monitoring the mortgage. Your lender is there to support you and take advantage of any opportunity to refinance the home. So the title cut off when I formatted this, but there are pros and cons to these grant funds. Basically, what I was trying to get at with this slide is that you want to get pre-approved by your lender, and you want to look at all these options and compare them. Make sure you're choosing the right one for you. Again, your loan officer, your real estate agent isn't going to be living in the home. They're not going to be making the payments. So get pre-approved, look at all the options, ask questions. Not all of these products are great and the right tool for everybody, but they are something that I would honestly look at and consider. So there's pros and there's cons for some of these products. Number one, some of these grants, the funds are very limited, and others, you can always use them, but it does add a little bit of extra documentation that could be required, a little bit of time and effort on your end when using some of these grant products. But I would certainly take advantage of it. Obviously, it can be well worth it. So how to apply for the grant? Well, work with a loan officer, identify which grants you qualify for. Look, if your income is below the limits, you're buying an area that's eligible. And that's something that we do. Your loan officer should. So you can, if you're interviewing a loan officer, just ask what's their experience with down payment assistance programs and grants, and what products do they have. Just apply like you would any normal mortgage. The biggest thing is you need to make sure that you're communicating, and your loan officer is communicating those with your real estate agent, and how that's going to impact your timeline. if it impacts your location of where you can purchase and your qualifications, because it can. There could be some changes based off of the higher interest rate. You may not qualify for as much. And it's just something to really kind of consider. Sorry, my son is peering over the top of my computer here, telling me to look at the comments. And I just see comments from him. But if you are watching this and you have any questions, go ahead and type them in, and I'll be happy to address them. What I hope to get out of this live is just giving a high-level overview about each of these grants and comparing them to the standard products. If you're watching the recording of this and you're still watching, thank you. There'll be chapters along the bottom. You can kind of hop to each section. What we want to talk about now is mainly for real estate agents. If you're a buyer, this is important for you. Be your own advocate and know these things. But this is for agents now, and it's about talking about how to write the offer, how to protect your client who is using some of these products. Okay, because there's going to be some changes, especially if you're using some of those grant products that could have the funds run out before you are able to use them, like the FHLB stuff that we were talking about earlier. So make sure that you know the difference between these grant products and the second liens and what they're using, because it can change how you need to write the offer and how you need to communicate with the listing agent. So get the exact name of the grant, the amount that they're getting, whether it's a grant, percentage of the loan, or a fixed amount. And again, if they still need a seller concession, because there's going to be some remaining funds after they receive the assistance, and make sure that you don't ask for too much. You can't walk away with excess funds. That money, if there's too much getting back from the grant and the seller concession, that's going to go back to the seller. So it's really important that you dive into the numbers with your loan officer, and that's communicated to you and your agent, so you can write the offer in a way that's going to maximize the competitiveness and take advantage of any concessions that you're getting. And you can read the other ones here. There is most likely going to be homebuyer education for any of these products that the buyer is going to have to do. Not much there, just requires a little bit of time, one evening that they would have to go through and complete the course. And you have to make sure that when you are writing the offer that you check the right box. We got to make sure we get the financing contingencies, again, the seller concessions. Make sure that those are dialed in and getting the right amount needed. And then depending on the product that you're using, a specific down payment assistance addendum or wording in the contract could be required. So here's an example. You can pause the screen here about how to word the contract if you are using a down payment assistance program. This could be a general addendum to the contract, but it's always best to include this stuff when you are ratifying the contract with the seller and not having to go back, because that could be an opportunity for the seller to back out. Here's some mistakes that we see that are commonly done, and that's not naming the down payment assistance program in the contract. Number one, in my opinion, is asking for excess seller credit when you don't need it, forgetting the specific addendums, and then leaving out, if there's any contingency based on the fact that the funds might be depleted before you end up going to closing, that could require the deal to fall apart. So you can still make your offer competitive even though you're using these products. Again, we've had several clients this year use down payment assistance grants and programs and still make competitive offers. What we want to do is we just want to button up the financing as much as possible so you can have really short timelines on these contingencies. You want to, include an escalation clause if you need to. Again, earnest money deposit could be, a benefit to you if you write a little bit stronger deposit with your offer. But it's our job to communicate these grants and these programs to the listing agent, make sure that they're educated and aware of how they work and operate and the due diligence that we've done up front. And you want to make sure that you write the contract correctly, because that's the way it protects you and your client and ensures fast underwriting, no last minute surprises or having to go back and get additional addendums to the contract. If we're, being clear and transparent to the listing agent, that's going to make them feel a little bit more confident. And what we want to do is just, again, work together to make sure that we are, protecting our client. So I do not see any questions. But if you do have questions and you're watching this replay, feel free to drop them, and I will monitor the comments of this video, and we can, always go back and reference there. But I appreciate everyone's time watching this. And again, if you give this a like, let me know if you want me to see a version for Maryland or DC, and I will do that in the future. Thanks again, and we'll see you on the next one.